So this is kind of different. We're moving away from individual taxation, giving a little taste of business taxation, partnership, and corporate taxation. So this chapter is focused on partnerships. Partnerships, I will tell you, they're kind of confusing. The concept itself is easy enough. Like, we just went through the whole Schedule C to see what it was, you know, what the tax treatment is for sole proprietorships, and really partnerships are just sole proprietorships but with more than one person. And so conceptually it should be sort of easy to figure that out, but in practice it can get a little bit confusing, especially when we start talking about basis. And I don't know if you've read the chapter yet or not, but we're going to talk about, we got a couple different, I mean, we're going back to this, the idea of basis and talking about basis, but we have two different types of basis for partnerships, called inside and outside basis. So there's a little bit of an extra complication there. But it like I said, it's simple but not easy. Maybe that's the best way to describe it. So anyway. So in this chapter, partnerships are a type of flow-through entity, pass-through entity. So it means that all of the taxable items are reported at the partnership level, but the partnership itself doesn't pay income tax, doesn't pay any federal income tax, probably doesn't pay any state income tax. It might vary depending upon the state. In the state of Iowa, it wouldn't pay any state income tax. All of that taxable income flows through to the owners or the partners based upon their ownership percentages. So what we're looking at here is, in this chapter, is how is it all recorded before it passes through to the owners, right? All right, so we're going to start out talking about how a partnership is formed. So there are a few ways that partnerships can be formed. I mean, it always involves some contribution of something from the new owners. Might be cash, might be assets, might be services. So we want to look at in those different types of contributions to a partnership to create it, what the tax treatment is, both at the time of the contribution and then after the fact as well. So we're looking at how partnerships are formed. We're also going to look at ordinary income and loss and how that is recorded. That's fairly easy. It's pretty much the same as we do on a Schedule C, how that ordinary income and loss is calculated. We have this new concept of separately stated items, and we've already talked a little bit about this because we talked about K1s in chapter 8, those pass-through entities, and how we've got certain types of income or loss that's reported on those K1s that's treated differently. Things like capital gains, right, and capital losses, dividend income, interest income, and how those types of things. So partnerships can obviously have those types of income, and when it flows through to the partner, how that's reported and how the partner has to then report it on their individual tax return. We're gonna go over our calculation of partner basis. Now we have like any other asset, I mean, a partnership is an asset. And like any other asset, we have a beginning basis, and then we have the basis of our asset changes over time. It could increase and it could decrease. So we're going to go through what types of events happen, what types of transactions happen to affect that changing partner basis over time. And this is important. It's important to keep track of what a partner's basis is, because if the partner ever sells their portion of the partnership, it's an asset, so it will have a gain or loss associated with it. Also, when partnerships experience losses along the way, not through the sale of the share of the partnership, but just like they have a loss in a particular year because they brought in less money than they actually spent, the partner's basis will determine how that loss is going to be accounted for on the partner's tax return. Distributions we'll talk about as well. This is where the partner gets funds out of the partnership when they pull money out, how that is calculated. And then what happens when a partnership liquidates, so ceases to exist, or when a partner sells their portion of the partnership, right? And how we do those calculations. Any questions right now? Now I mean, I do have to, I guess I'll ask you that question in just a second. I have to tell you, so this chapter is, the terminology can be a little bit different. I mean, it's a difficult concept to kind of wrap here. I just said it was easy, but the concept itself is a little bit difficult to wrap your head around, and some of the terminology can be, you can easily get tripped up on it. So if there's at any point you're like, I don't understand what you're saying, please interrupt me, okay? I get tripped up on it too, and I have to kind of slow down to think it all the way through when I'm explaining it to everybody. That's it. Any questions? Okay. So let's talk first